The 2008 financial crisis was one of the most devastating economic collapses in modern history. It wiped out trillions of dollars in global wealth, led to millions of job losses, forced governments to bail out failing banks, and plunged economies into recession. It was a financial disaster that exposed the weaknesses of the global banking system and reshaped how governments and institutions handle economic crises. But here's the real question. Could it happen again? Fast forward to 2025. Global debt levels are at record highs. Inflation remains a constant concern. Stock markets are hitting all-time highs despite growing economic instability. And fears of a major real estate or banking collapse are looming. The signs of a potential crisis are everywhere. But what if, in 2025, the world experiences another economic crash on the scale of 2008? Or worse, how would it happen? What industries would be affected first? Would governments and banks be prepared? Or would we see a financial meltdown that surpasses anything we've seen before? While no two financial crises are exactly alike, they often follow similar patterns. The 2008 crisis was triggered by reckless lending, excessive debt, and a housing bubble that ultimately collapsed. Right now, similar red flags are appearing in global markets. Debt levels have soared to historic highs, particularly in the United States and China. Governments, corporations, and individuals are borrowing at unsustainable rates, fueling concerns that the financial system is once again on shaky ground. One of the biggest concerns is the housing market. In many major cities around the world, home prices have skyrocketed to levels that far exceed average incomes. This echoes the conditions before 2008, when risky mortgage lending led to a housing bubble. If real estate markets suddenly cool down or crash, it could trigger massive losses for banks, investors, and homeowners, just like what happened before the last crisis. Another potential trigger is the stock market. Over the past decade, markets have been on an unstoppable rise, fueled by low interest rates, corporate stock buybacks, and government stimulus programs. But stock markets can't keep going up forever. If overvalued stocks suddenly collapse, a chain reaction of panic selling could trigger a global market crash. Then there's the banking sector. Many large banks claim to have learned their lesson from 2008, implementing stricter lending rules and financial regulations. But some experts argue that banks are still taking enormous risks, just in different ways. A major bank failure in 2025 could send shockwaves through the economy, just like the collapse of Lehman Brothers in 2008, which marked the beginning of the financial meltdown. If another crisis like 2008 were to hit in 2025, the first signs would appear in financial markets. Stock prices would plummet as panic spreads, wiping out billions, if not trillions of dollars in market value within hours. The Dow Jones, S&P 500, and global stock indexes would experience record-breaking losses, triggering trading halts to stop markets from collapsing too quickly. Banks and financial institutions would freeze lending, fearing widespread defaults. This would lead to a sudden credit crunch, where businesses and consumers are unable to access loans, further accelerating the economic downturn. Small businesses that rely on financing would immediately struggle, forcing many to close or lay off workers. Investors and depositors would rush to withdraw money from banks, fearing insolvency. Some banks might impose withdrawal limits, preventing customers from taking out their funds, which could trigger widespread panic and even bank runs. Governments and central banks would scramble to contain the crisis. The Federal Reserve, European Central Bank, and other monetary authorities would announce emergency measures, including massive interest rate cuts, stimulus programs, and bank bailouts. However, these measures might not be enough to stop the downward spiral. As the crisis unfolds, job losses would skyrocket. Companies unable to secure financing or facing declining sales would lay off workers by the millions, leading to record-high unemployment rates. The sectors hit hardest would likely be finance, real estate, retail, and manufacturing. The housing market would crash, with home prices plummeting overnight. Homeowners who purchased properties at inflated prices might find themselves trapped in debt, unable to sell without taking massive losses. Mortgage defaults would spike, leading to a new wave of foreclosures. Banks holding these bad loans would face severe financial strain, putting even more institutions at risk of failure. Inflation and interest rates would become a major problem. In an effort to stimulate the economy, central banks might print money at an unprecedented rate, but this could lead to hyperinflation. At the same time, borrowing costs would rise, making it even harder for businesses and individuals to recover. Governments would be forced to introduce massive bailout packages, just like in 2008. But unlike 2008, where stimulus spending was used to prop up banks and corporations, the public might demand direct financial aid, similar to the stimulus checks issued during the COVID-19 pandemic. However, this could add trillions of dollars to national debts, worsening the long-term impact of the crisis. No country would be safe from a financial crash in 2025. The US economy remains the backbone of global finance, and if it collapses, other nations would quickly follow. Europe, still recovering from past economic instability, would face another major recession. Many European banks have exposure to high-risk debt, and a new crisis could push weaker economies like Italy or Spain into complete financial collapse. China, the world's second-largest economy, would also be at risk. The Chinese real estate market and debt levels are dangerously high, and a global financial collapse could trigger a banking crisis within China itself. Emerging markets would suffer the most. Countries that depend on foreign investment and international trade would see their economies shrink rapidly. Currencies would lose value, inflation would spike, and millions of people in developing nations could fall into poverty. Despite the warning signs, there are key differences between 2025 and 2008 that could help prevent a full-scale collapse. Governments and central banks have more experience dealing with financial crises, and many institutions now have stronger regulations in place to prevent reckless lending. Technological advancements, including AI-driven financial monitoring systems, could detect early signs of crisis and trigger preventative measures before things spiral out of control. Digital currencies and blockchain technology could also provide alternative financial systems that bypass traditional banking failures. However, if the crisis does happen, recovery could take years. The lessons of 2008 showed that governments must act quickly to contain economic damage. If they fail, the global economy could be thrown into one of the worst financial collapses in history. The financial system is always vulnerable to bubbles, risky investments, and economic downturns. Whether it's real estate, banking failures, stock market crashes, or global debt, the factors that caused the 2008 meltdown are still present in 2025. If another crisis hits, the world may not be able to recover as quickly. Debt levels are already sky high, inflation is a growing concern, and economic inequality is worse than ever. While governments will try to contain the damage, the question remains: can they prevent a total economic meltdown, or are we heading toward another financial disaster? The next few years will determine whether we have truly learned from the mistakes of 2008, or if history is about to repeat itself in an even more devastating way. That's it for today's video. If you enjoyed it, make sure to drop a like and subscribe to our channel. Thanks for watching.